Subscribe to our solution tips, SOP advice, and ERP glossary. How can a business owner know how long it takes to make money on the purchased supplies or the products? In this lesson, we will examine the two different methods for calculating the length of time it takes to make a profit. So today we are going to understand the two operating system, which is the operating cycle and the cash conversion cycle. Peter owned a company that sells office supplies to other companies. They buy the supplies from the people that make them. Then they hold them in their warehouse, which is called inventory, and then sell and ship the inventory to their customers, which is the other company. Most businesses, they has actually run their business in one or two ways. They buy the supplies or they manufacture the products and then they pass on the products to the customers. Just like Peter's company, they buy the products and resell them to the customers. Either way, it is important that company keep track of how long it takes them to make money after they buy the supplies, because the shorter the time is, the better for your business operating planning. So, how can Peter know how long it takes him to make money on the products he buys? There are two different ways, the operating cycle and the cash conversion cycle. Let's take a closer look at each of them now. What is operating cycle? One way that Peter could keep track of how long it takes to make money after he buys inventory is the operating cycle, which is the best method to use if the company pays for their supplies or products at the time of sales. When the companies pay for something at the time of sales, it is said that they are paying in cash. And actual method, they can pay by writing a check or by transferring funds from one bank to another. Yeah. So in the operating cycle, there are three basic steps. The first is the company buy inventory with cash. For example, Peter just bought a big shipment of computer from a computer company. He wrote a check on the day that the deal was made. The computer are now sitting in his warehouse waiting to be sold off. The second is the company sell the inventory for credit. A week after Peter's company received the computer, a store bought the computer from them. Unlike Peter, the store didn't write the check when they bought the computer. Instead, Peter gave them 30 days term after the sales happened. Peter goes ahead and ships the computer to the store, and then they will pay him after 30 days have elapsed. Number 3 is the company receives payment for the shipments. Finally, after 30 days have passed, the store writes Peter's company a check for the sales. They have now received the money and the cycle is complete. So, what does this three operating cycle tells Peter about the length of time it takes him to make money after buying the inventory? If you are a business owner, it is important for you to know the length of time it takes you to make money after buying a inventory, not getting the inventory sitting down in your warehouse. Yeah? Operating cycle can be calculated by adding the inventory period, or how long Peter has inventory in his warehouse, and the account receivable period, or how long after the sales takes for the company to pay. Remember that the computer sat in Peter's warehouse for a week before he sold them to the store, and then it took the store 30 days to pay. If Peter add 1 week or 7 days to 30 days, his operating cycle is 37 days long for this deal. That is not bad, right? So, a company organization structures can influence the operating cycle. It is very critical that different leaders communicate clearly to keep things moving in the operations planning. For example, Peter's sales managers need to let the billing department know quickly that the store has 30 days term to pay, so the billing departments can follow up and keep things on track. Otherwise, the company operating cycle can be stretched out. So, what about the cash conversion cycle? As we say, the operating cycle is best used when the company pay cash for their supplies or their products. Remember that Peter wrote a check at the time that he bought the computer? But what if, like the store that Peter sold to, Peter wanted his company to buy inventory on credit instead of cash and pay for it later? The best option then is not to use the operating cycle, but to use the cash conversion cycle, which is about converting the credit of the company into cash. That is, it looks at how long it takes the company to make money when they buy their inventory with credit. The first 3 steps of the cash conversion cycle are just like those of the operating cycle. The company buys the supplies or the products, in this case with credit instead of cash. Then they sell the inventory for credit, and then they receive the payment for the shipments of the inventory. But that's the 4th step in the cash conversion cycle. The company pays their supplier for the inventory. For example, if Peter had bought the computer on credit, he would eventually have to pay the computer company for them. The cash conversion cycle can be calculated by adding the inventory period and account receivable period and then subtracting the account payable periods, or how long it takes the company to pay its supplier. The best options for most companies is to have a short inventory and account receivable period to get their money fast, but a long account payable periods. That's really shorten the periods that the company has to go through before paying. For example, let's say Peter has to pay the computer company 15 days after he received the computers. Remember that his inventory periods and account receivable periods together were 37 days. If Peter subtract 15 from 37, his cash conversion cycle is 22 days long. But what happens if Peter lengthened the account payable periods? Let's say that he has 30 days to pay instead of 15 days. Now his cash conversion cycle is only 7 days long. That's it. It will have made a profit in 7 days instead of 22 days. That's even better, right? So, what is the lesson summary you have learned today? In business, you have 2 ways of keeping track on how fast it takes them to make money on your purchase. The first is the operating cycle, which is the best method to use if the company pay for their supplies of products at the time of the sales. And there are 3 basic steps in the operating cycle: buying inventory with cash, selling inventory for credit, and receiving payments for sales. The operating cycle can be calculated by adding the inventory period and the account receivable periods. If the business pay for their supplies or product with credit, it is best to use the cash conversion cycle, which is about converting the credits of a company into cash. That's it. It look at how long it takes the company to make money when they buy their inventory with credit. The first 3 steps of the cash conversion cycle are just like those of the operating cycle. There are a 4th step in the cash conversion cycle. The company pays their suppliers for the inventory. The cash conversion cycle can be calculated by adding the inventory periods and account receivable periods and then subtracting the account payable period. That's all for my sharing in this video today. If you are very interested in checking out with us, please scan the QR code down below here. It's got the link to the private group. You will be able to discuss your problem with us in the group. Tell us exactly what you are looking for, and we will be able to get back to you to see how we can help you in your business. Apart from that, please like this video, share, and give me some comments. This is super important because this gives me an encouragement to continue posting more content video like this every single week to help you understand the business in all areas. Last but not least, my name is Vivian. If you are really interested and wanted to learn more about manufacturing, distributions, financial, or learning about warehousing, or transforming your business challenges with me, this is the channel for you. Thank you very much for tuning in, and I see you in my next video. Subscribe to our solution tips, SOP advice, and ERP glossary.